Here's a blunt truth. One number, just one, quietly controls your entire financial life. Your mortgage, your rent, your credit card bill, how much car you can afford, even whether your boss is hiring or firing. That number? The interest rate. And once you understand how it works, you'll stop being on the losing side. Welcome back to Budget and Build. Let's break this down. The price of money. In 60 seconds, take a £300,000 home. At 3%, the mortgage is manageable. You build equity, you come out ahead. At 6%, the maths flips. 10 years later, the house value and the cost of owning it are basically the same. Push rates higher, now you're paying more for the home than it's worth. That's not a bad deal. That's a wealth trap. And the same logic applies to credit cards, business loans, car finance, student loans, national debt. High rates drain wealth, low rates build it. Why not just keep rates low forever? Because cheap money creates bubbles. Low rates, cheap borrowing, more buyers, higher prices, greed, bubble, crash. It takes 5-10 years for prices to explode. It takes 1-2 years for everything to collapse. And then, years of recovery. If you buy too late, you get the worst deal. The highest prices, the highest interest, the lowest chance of profit. Timing matters. But the cycle always repeats. Who controls this? Every country has a central bank. In the UK, it's the Bank of England. In the US, the Federal Reserve. They set the base rate, which sets the price of every loan in the economy. And because the US dollar runs the global system, whatever the Fed does, hits. The UK housing market, the FTSE, inflation, your mortgage offer. A tiny rate change in the US can shake markets around the world. The pandemic proved everything. 2020, rates collapse, mortgages hit record lows, housing demand explodes, prices skyrocket. 2022, inflation surges, rates shoot up, mortgage rates double, affordability evaporates. Nothing about the houses changed. The price of money changed. Here's where it gets unfair. Low interest rates are a lifeline for normal people, but for the wealthy, low rates are a weapon. Corporations borrow billions for pennies. Big companies issue corporate bonds. If government bonds pay 1%, Apple can offer 1.3%. Institutions buy them immediately. That's how Apple raised billions, cheaper than what normal people pay for a car loan. The rich borrow against assets, not income. When rates are low, they don't sell shares, they don't sell property, they don't pay tax on gains. They just borrow against their portfolio at ultra cheap rates and live tax free. Borrow at 2%, invest at 8%. Keep the difference, every year, for decades. They use interest rates. Most people get used by them. So what do? You can't control the Bank of England, but you can control how you play the cycle. When rates are low, lock in fixed mortgages, refinance debt, invest steadily, borrow only for productive assets. When rates are high, avoid liabilities, build cash, pay off expensive debt, prepare for opportunities. It's simple. Cheap money is when you advance, expensive money is when you protect. The takeaway. Interest rates quietly decide whether you build wealth or fall behind, whether you own a home or get priced out, whether your job is secure or your department gets cut. You can ignore stocks, you can ignore crypto, but you cannot ignore interest rates, because whether you realize it or not, they already run your life.